Something important has changed recently, and almost no one is talking about it. No breaking news alerts, no major headlines, no clear warning to the public. But behind the scenes, the rules tied to the $10,000 bank reporting threshold have quietly evolved, and not in your favor. In fact, over the past 2 years, multiple updates and enforcement changes have made it significantly easier for everyday Americans, especially retirees, to get flagged, delayed, or reported simply for moving their own money. This is not about something coming in the future. This is already happening right now in banks across the country. And if you are not aware of it, you could run into problems at the exact moment you need access to your money the most. In this video, we are going to break down 5 major changes that have reshaped how this rule works today, and more importantly, what you can do to protect yourself. But first, let me tell you a quick story. Martin is 71, Carol is 68. They live a quiet, comfortable life just outside Phoenix. Nothing flashy, just decades of hard work, careful saving, and responsible planning. Last year, they decided to replace Carol's car. Instead of financing, they chose to pay in cash to avoid interest. They found a deal, negotiated the price, everything was set. The next morning, Martin went to his bank to withdraw around $40,000. Simple enough, right? Not anymore. Instead of getting his money, he was asked to step into a private office. The bank manager began asking questions. Why do you need this much cash? Did someone tell you to withdraw it? Have you received any suspicious calls or messages? Have you met anyone online recently? Imagine that, a 71-year-old man completely capable being questioned just for buying a car. Even after explaining everything, the bank did not release the money immediately. They delayed it for 3 days. And that was not the end of it. A few weeks later, Martin received notice that his transaction had been flagged and reported. He did not break any laws. He did not do anything suspicious, but the system still treated it like a risk. And that is exactly what is changing. To understand why this is happening, you need to understand one key fact. The $10,000 threshold was created back in 1970. Think about that for a second. In 1970, $10,000 was a massive amount of money. Today, it is not unusual at all. Adjusted for inflation, that same amount would be closer to $80,000 today. But the rule has not changed. The numbers stayed the same, while everything else got more expensive. That gap is what is causing problems, because now completely normal financial activities regularly cross that threshold. Buying a car, home repairs, medical expenses, helping family, all of these can easily trigger reporting today. And on top of that, enforcement has become much more aggressive. Let us go through the 5 key changes. Change number 1, delayed access to your money. Banks now have more flexibility to temporarily hold transactions, especially when it involves older customers. If your activity suddenly looks different from your usual pattern, it can trigger a review. For example, if you typically withdraw small amounts and suddenly request a large sum, that change alone can raise a flag, even if everything is legitimate. That review process can delay access to your money, sometimes for days. And here is the part most people do not realize. Banks do not always have to clearly explain why it is happening. Change number 2, the structuring risk. This is where people unknowingly get into trouble. Some think they are being smart by breaking up transactions into smaller amounts to stay under $10,000. But doing that intentionally can actually create more problems. Because the system now looks for patterns, not just single transactions, and those patterns are being analyzed more closely than ever before. Even if your money is completely legitimate, certain behaviors can trigger reviews or reports. Change number 3, digital payments are now included. It is not just cash anymore. Digital transactions are now part of the same monitoring environment. Apps like peer-to-peer payment platforms, online transfers, and even crypto activity are increasingly being tracked and reported under updated rules. And reporting thresholds for some digital payments have dropped significantly in recent years. That means smaller transactions, things that used to go unnoticed, are now being recorded and reviewed. Change number 4, businesses reporting your transactions. Whenever you make large payments to businesses, whether it is a contractor, dealer, or service provider, they may be required to report that transaction. And the penalties for not reporting correctly have increased, so businesses are more motivated than ever to document everything properly, which means more transactions involving your name and details are being formally recorded, even when everything is perfectly legal. Change number 5, the inflation problem. This is the root of everything. The rule stayed frozen, but real-life expenses did not. So now normal financial behavior triggers systems that were originally designed for rare or extreme situations. That is why more everyday people are being caught in these processes. Not because they are doing anything wrong, but because the system has not adapted to modern financial reality. Now let us talk about what you can actually do, because awareness alone is not enough. You need to adjust how you handle your money. Protection move number 1, communicate with your bank. Before making a large transaction, give your bank a heads up. Explain what you are planning and why. This simple step can reduce the chances of delays or complications. Protection move number 2, avoid suspicious patterns. If you need to move a certain amount, do not overcomplicate it. Trying to work around thresholds can sometimes create more tension instead of less. Protection move number 3, consider alternative transfer methods. For larger transactions, electronic transfers can often be smoother and more predictable than cash. Protection move number 4, keep records. Document your transactions. Know where your money is coming from and where it is going. If questions ever come up, having clear records makes a big difference. Protection move number 5, stay informed. The rules are evolving, and most people only find out after something goes wrong. Staying informed puts you ahead. Here is the bottom line. The financial system is not the same as it was decades ago. The rules may look familiar on the surface, but the way they are enforced today is completely different. And if you are still operating based on old assumptions, you could run into unnecessary problems. Not because you did something wrong, but because the system flagged something you did not even realize mattered. If you found this helpful, make sure to subscribe to American Benefit Watch. We break down important financial changes in simple terms, especially the ones that are not being clearly explained elsewhere. And if you know someone, a parent, relative, or friend who should be aware of this, share this video with them. Because the sooner people understand how things are changing, the easier it is to stay one step ahead.